Let's start with the news. Hugh, what's the latest on First Republic?
Hey, Kelly, great to be with you. So we were able to shed some light on the approach that First Republic's advisors would have in trying to save the bank, which is essentially, as David Faber reported on Tuesday, the plan was basically to convince the banks who've already put in $30 billion into First Republic in the form of deposits to once again help out by overpaying essentially for bonds that are on First Republic's balance sheet. So paying higher than market value, which on its face was a tough ask.
Yeah.
And so my question, to the advisors was, why would the banks go for it? And the answer is, the coercion that was set to happen is basically the pitch. If you don't do this now and take a hit to the tune of several $1 billion in total for all the banks, then when this thing goes into receivership, the FDIC special assessment fees that you're going to have to pay could be the tune of $30 billion.
Right.
So it is in your financial interest to save First Republic now.
That was First Republic's pitch. After you reported that story, the shares absolutely tanked. So if you're the big banks, you're going, it's obvious that the market hates the idea of us getting more involved here. They already feel probably like they've been tainted by giving the $30 billion, and now there's questions about whether they can even get that back. And now they're kind of looking at this like a lose-lose. Well,
I would have to say there are a couple observations. This is the kind of brinkmanship that needs to happen before, the players are finally impelled to move. Earlier today, David also mentioned the idea that the government might be reluctant to coerce, the big banks to actually act. And if that's the case, the conversations I had with the bankers, the advisors to First Republic was, we need the government. We need them to actually corral all these players to, just like in 2008 and 2009, get the CEOs in a room together so we can sort of browbeat them into doing the right thing. And if they don't have the government to act, I don't know that their plan is going to actually get to fruition.
Not just that, but look at what's happening in the marketplace today. Even as FRC keeps struggling, we see PacWest, we see the others acting resilient. Maybe we could describe it as that's not going to galvanize either the private or the public sector to come to First Republic's rescue here, because these are trial balloons. If it was bringing down the whole industry and the whole markets, that'd be a different story.
I think I agree with what you're saying. If there's bifurcation, if it seems like First Republic is isolated in this case, then it gives more ammunition to regulators to say, let this play out at least.
And they want, it sounds like, to show that they are willing to let banks fail. I mean, wouldn't you say they won't even be explicit about what exactly is the situation with deposit insurance?
Well, they want optionality, and they want to avoid the worst case scenarios. And if it is possible that this can be resolved without any whiff of government, bailout, government assistance, and private market solution, that's the preferred route.
Yeah, real quickly, Hugh, and it's been great reporting. We really appreciate it. But give us a sense of the time frame here,
Yeah, I mean, certainly the sense I got from, the advisors is that they want to create a sense of urgency. They want this to happen soon. And there's a couple of reasons for that. One is, this is a degrading asset. There is a talent flight. There is, the possibility that in future quarters, they're just going to have quarterly losses. They're going to have an upside-down balance sheet if they don't get this fixed. So there's really a lot hanging on this, and they don't want to let this play out for much longer.
Yeah, already it's been festering for quite some time. Hugh, thank you. I'll let you get back to it, our Hugh Sun.